back to the CNBC TV 18 special, The World Economy in 2015. My guest is George Magnus, Senior Economic Advisor to UBS. Mr. Magnus, before the break, you were telling me about the various big economies, and all of them seem to be in a situation of economic downtrend. Under the circumstances, how do you expect commodities to behave? Is the commodity supercycle definitely over? How largely will commodities behave in 2015, especially crude?
Yeah, I think the long run-up in commodity prices, or the super cycle, as it was certainly called, as you suggest, I think that's pretty much over. Not necessarily for soft commodities or agricultural commodities, because obviously, we all got to eat, and we have cattle to feed, and animals to look after. So the agricultural side of this, actually, I look at rather differently from industrials and from oil and gas. But I think that the biggest single influence over industrial commodity prices during the last 10 years has been China, which had a very commodity-centric kind of growth model. I think that growth model is now changing. And whatever growth we get out of China, whether it's 6% or 5% or 4%, will be much less commodity oriented. And so, from Perth to Peru, to use an alliteration, I think that industrial commodities are going to be under pressure, aided and abetted, I might add, by the strength of the dollar. So since a lot of these commodity prices are priced in dollars, dollar-based commodity prices in the industrial complex, I think will continue to be weak or weaken further over the coming year.
That's actually good news for economies like India, which are net commodity importers. Of particular interest and importance to us is crude prices. Does it get worse for crude in 2015? Are we going to see it average a good 10-20% lower than the average of 2014?
I'm not sure that I want to give a hostage to fortune about what will happen to oil prices over the next 3 months. But I think that some of the big trends in 2015, at least two of them, will be uninterrupted. One is the declining commodity-centric nature of China's growth rate, and the other, of course, is America's remarkable shift in energy import intensity. So 3 or 4 years ago, the Americans were importing 10 million barrels a day of oil or liquid fuels. Now it's about 5.5 million. Next year, people think it's going to be around 4 million. So that's an amazing change, which I think will continue to bias the price of fuel downwards. And of course, as you say, for countries like India, this is like manna from heaven.
Oh, absolutely. That brings me directly to India. Has been one of the most favored equity markets. At least the growth delta has been higher, even if the level is fairly south of China. How are you assessing the prospects of the Indian economy? Is it looking much better going into 2015, and the equity markets as well? I'm not always best placed to actually relate, GDP to equity markets. So the correlation doesn't always work terribly well. But I would say this, because I look at emerging countries, obviously, very much through a kind of a global lens. And the government change came in on the right foot. It started to do the right things. It's got a message that resonates incredibly well with domestic and international investors. And, lower energy prices will help you, but obviously most of what's happened is homemade and homegrown, and obviously from an international perspective, it's to be hoped that this will continue, and that the government will continue to make progress in making good some of the shortfalls that have been allowed to fester in India during the last kind of 5 or 6 years. The signs look quite promising, I have to say. Okay, well, let me get back to the global ambience, especially the financial world, since that's also important for the India growth story. You spoke about Japan definitely loosening its strings, printing more yen, and Europe as well. What's the global liquidity scenario looking like? Looks like there's going to be a lot of money printing. Well, mathematically, you can look at what the Bank of Japan is doing and to its balance sheet and what the ECB promises or thinks might happen to its balance sheet. And mathematically, you could kind of weigh that up against the termination of QE in the United States and say, well, it's a wash. It doesn't really make that much difference, and therefore the world is still awash with liquidity. In the real world, I'm not really sure it works quite as simply as that, because dollar liquidity, is different from yen liquidity or from the ECB's liquidity, in the sense that, of course, the US dollar is the world's reserve currency, and it kind of flows around the world more readily than do the other two currencies, although the euro, of course, is much, much bigger than the yen. But I think the principal focus I think we should have really is on the US. So QE may have ended, but zero rates obviously still are very much with us for the foreseeable future. If that were to end at some point in 2015, even if that were a change in interest rates which didn't go very far, I think it would be quite shocking in the initial stages. I think it would have quite a significant disruptive effect on capital flows at a time when the US external payments position is improving because of the energy balance in particular. So I think for next year I'm quite watchful and quite sensitive to the impact which a strong dollar and higher interest rates, if they happen, might disrupt global liquidity. And of course that could affect emerging markets in the same sort of way as it did in the Asian and tequila crisis in the 90s.
Yes, that's exactly what the Indian Central Bank governor constantly worries about and warns about. What should India be prepared for as soon as the first signs of a rate hike emerge? Will there be a massive capital outflow, you think, in countries including India?
Well, I think there's been since we've had the kind of 2 or 3 kind of taper tantrums. The first one of which, of course, India was very much a kind of a victim of, although that dissipated, I think, on the kind of second and third iterations, not least due to the policies of the Central Bank, the Reserve Bank of India itself. But I think the danger is, of course, for those countries that are heavily reliant on financial inflows to plug external deficits or, by implication, fiscal deficits as well. And this is, it may not be as much a source of vulnerability to India as it was, say, 18 months ago, but at the moment it still would be a sense of vulnerability, and of course that's the kind of context in which we need to kind of look at this. But I think as much as anything, the probability is not that India would be singled out necessarily, but that actually if interest rates in the United States did go up, it would be a shocking development for investors who have been accustomed to a totally different monetary regime for the last 6 years. And I think it might increase what we call home bias, and it might increase the sensitivity of emerging countries to capital outflows. Not because conditions are the same as they were in the 1990s. Many have much less external debt and much higher levels of reserves, but capital flows are more mobile. Foreigners own much higher proportions of local currency bond markets. So I just think it's something we do need to be a bit watchful for.
Okay. Well, that brings me to the question which will really plague most investors in the coming days. What might be the most winning assets or asset classes in 2015, at least in the first half, according to you?
Well, I say this slightly reluctantly because I'm not sure I'm a 100% believer, but almost by process of elimination. I actually think that so long as we have zero rates in the United States, and so long as the ECB and the Bank of Japan remain committed to QE, quantitative easing, I think equities by default are likely to be, the more attractive asset class relative to bonds and to even to real estate and to corporate credit and so on, which are quite fully priced in my view. So equities have had a great run. And by many kind of standards of valuation, they're either, well-valued, a little bit expensive, kind of take your pick. But I guess it's got further to go, to be honest. But I'm getting, the higher they go, the more nervous I become.
Okay, and within equities, your pecking order? I mean, I want to know where India figures.
Well, you know, I think sort of the main lesson in sort of equity market investing that I always draw is, you know, never to buy the markets that have had the biggest run-ups to date. So, you know, my temptation would be to look at some of the emerging markets that haven't enjoyed, you know, what India and maybe China have enjoyed over the last several weeks. I still think the old S&P has life left in them bar hills, as they say.
Okay.
And I think U.S. equities still look like they've got further to go.
George Magnus, it was a pleasure speaking with you. Thank you very much for joining us on the first of the world economy in 2015.
Thank you.